We are heading into a truly worrying time with property prices set to crash, the stock market having already crashed could crash even further, and the UK on track to go into a deep recession. Hello and welcome back to yet another video. My name's Connor, I hope you're doing well, and if you have not done so already, remember to hit that subscribe button. We are fast approaching 200 subscribers, which is just awesome, so thank you all for your support. Also, why not hit the like button while you're there? And if you have any questions about anything I discuss in this video, hit me up in the comments down below. So in today's video, I'm going to be taking a look at the latest property market data, credit card data, car finance data, mortgage and new build data, and any general economic data as well, plus give a quick update on the pound. This is all to gain a deeper understanding of where we think the property market could go. So let's start with credit cards, those pesky things that can be an amazing tool for helping you build wealth or completely ruin your life. The cost of living crisis is really starting to show itself, with 1/5 of Britons being forced to borrow more money to meet their payments, and half of them unable to save anything at all, according to data from the ONS, the Office for National Statistics. The ONS also found that in the 2-week run-up to September 25th, 22% of the UK reported having to borrow more money or take out credit. This is an increase of 6 percentage points from November last year when this survey was first conducted. The ONS findings actually correlate with those of the Bank of England as well, who reported credit card borrowing has increased at its fastest rate in 17 years, with the two biggest increases coming from those both in the 30 to 49-year-old age category and the 16 to 29-year-old age category. And to make things worse, 1/3 of the UK population report being unable to afford an unexpected expense of £850, for example a new appliance, and which found that 18.2 million households have had to cut back on essentials, sell items, or dipped into their savings. The energy crisis is worsening and causing people more headaches every single day, with the ONS reporting half of its respondents said they struggled to afford their energy bill in September, with 2/3 of Brits reducing their spending on essentials such as gas and electric and groceries. Despite the government introducing an energy support package which caps household energy bills at £2,500 per year, it is expected that a large chunk of the population are still going to struggle to actually pay their energy bills. We have mortgage rates skyrocketing and new build purchases plummeting. Santander, the 4th largest mortgage lender in the UK, has hit headlines this week with its news that it is increasing its standard variable rate by 0.25 percentage points to 6.24% from the start of November, and its 2-year fixed rate mortgages now have an interest rate of 6.04%. Mike Rayner, CEO of Santander, actually said, "We've seen a very slight increase, but not yet a significant increase in the number of customers who are falling behind on their mortgage payments or payments on cards, loans, or overdrafts." Santander UK has about 11% of the mortgage market, a book of £184 billion of home loans as of July. It put aside £66 million for potential defaults in the second quarter, up from £52 million in the first 3 months of the year, a sign that things are potentially going to get worse. We also have Barratt, a UK new build developer, warning of weakening demand, with new build reservations dropping by 1/3 from 281 per week in its last fiscal year to 181 per week now. And they have reported expecting a less certain outlook. Plus, they are reportedly expecting an inflation in build costs of up to 10%. Which is most likely to be passed on to the buyer, causing prices to increase further. Next, we have car finance data. Financing of cars has grown exponentially over the last 10 to 15 years, with the average amount of money borrowed on a new car more than doubling, from £11,964 to £25,039 between 2009 and 2022. Similarly, the average amount borrowed on a used car has increased by 87% over the same period, from £8,444 to £15,771. To put these massive increases into context, the average weekly earnings have only increased by 33% over the same period, showing just how much people have actually leveraged themselves. And finally, we come to the pound. The pound dropped sharply yesterday, and government borrowing has hit its highest levels since the financial crisis, after the Bank of England Governor Andrew Bailey sent markets into fresh turmoil. What happened to cause the pound to drop even further? Well, Mr. Andrew Bailey, the Governor of the Bank of England, warned of its emergency support package for markets would end on Friday. Basically, Bailey's announcement has created uncertainty about what is to follow after the withdrawal of the support package. Financial analysts have predicted gilt prices would be a roller coaster in the coming days. If the pension funds reliant on liability-driven investments have not been able to shore up their positions and gilt yields rise, there could be another fire sale causing the pound to drop even further. It is unlikely that the government will have gained the confidence of the markets by then, unfortunately, as it is not due to present its plans drafted by the Office for Budget Responsibility for balancing the public finances until the 31st of October. So, what does all of this data actually mean for property prices and where they're going? Well, to be totally honest, it doesn't look very promising, and my opinion has actually started to shift from believing we could see a small fall of 5 to 10% to potentially seeing a large fall of anywhere from 20 to 40%, which I realise is a massive range. There's a huge range there. However, just how far property prices fall is really anyone's guess, and the reason I've upped the amount that I think property prices will fall is because things are just starting to look really bad. We have officially entered a recession. People who are remortgaging are now realizing just how expensive their homes are to run. You know, with people going from a 1.5, 1.79% interest rate up to 6%, that's huge, you know, and that's we're talking hundreds of pounds difference here, and people just can't afford it, especially when you consider that the cost of living crisis is still worsening. We still have the winter energy bills to rise. So where prices go, as I said, is really anyone's guess. However, one thing is for certain, and that is that property prices really do have to go down at some point in the near future. Well guys, there you have it. I really hope you found this video useful. If you did, remember to hit that subscribe button, tap the like button as well, and let's get this video shown to as many people as possible. I will see you in the next one.